Let me welcome on board then Rajesh Kothari and find out what he's making of the market right now. Rajesh, hi, afternoon. Let's start off with banks, exactly what our experts were talking about, because seems like that's where valuation comfort is. The FII is clearly making a comeback, and their first port of call is private banks. Do you believe this is going to be a sustainable move?
Well, I think entire banking and finance we divide into multiple subsegments. So we have a private sector banks, then we have a PSU bank, then we have NBFCs, and then there is something called others, which includes insurance, asset management companies, wealth management companies, and exchanges. Correct. So what we do is that we look at the from growth perspective each of the bucket, and then within that, of course, each of the companies, and accordingly, construct the portfolio. Coming to private sector banks in particular, I think the growth is going to be there strong in FY24, particularly second half, in terms of the loan book growth. Net interest margin can be a little bit under pressure, but that's true for the entire sector, be it a PSU bank or be it a private sector banks. But I think in last 4 years, the PSU bank's profit growth, because of the lesser credit cost, was significantly higher than private sector banks. I think next 3 years, that gap is not going to be big. In fact, the private sector banks actually can do better than public sector banks in terms of the overall earnings growth, because the bulk of that benefit of credit cost is already behind us. So I think private sector banks should do well from here on. I don't see any reason why they should not do well. Of course, valuations are comfortable. They're already compressed in last 3 years. So there is another positive thing in terms of the margin of safety. So can they deliver 15-18% the profit growth on compounding basis over next 2-3 years? I think that's high possibility.
Talk about the winners then during the COVID era. Definitely it has to be the IT sector, the pharma sector that have been that were the winners then. But from there on, they've actually faded away. The flash on the bottom of the screen that we're seeing is that rupee has hit a fresh record low against the dollar, which should ideally be beneficial for the exporters like IT or pharma sector. But what's your view coming on both of these sectors? Fundamentally, where do you see these sectors headed?
The IT sector, we are still underweight. I think the global IT spending is going to take some more time before we see the some signs of pickup. But and at the same time, there are many other opportunities in Indian economy which are likely to do very well. Capex is one theme which we have been playing from last almost 4 years. So we are very positive on overall capital expenditure related themes. We are of course very bullish on automobiles and auto ancillaries, and consumer discretionary was our favorite from last 4 years. Incrementally, we are even getting positive on little bit on the consumer defensive. So I think these three themes are going to play, if you ask my personal view, going to do much better compared to the other segments, be it IT, be it healthcare, or be it banking. So on a relative basis, I think the auto, capex, and consumer are the top three themes to play, compared to the other sectors.
Right, okay, that's the themes that you're lacking right now. But Rajesh, purely on a market cap basis, does it seem like that the focus has now moved to large caps because of the FII participation picking up as well? And maybe we see at least time-wise consolidation, if not correction, when it comes to the mid and small caps?
I think a stock price is a mirror of earnings growth. It is a slave of earnings, irrespective of its market cap. So what is most important is the underlying profits and underlying ROC, and of course underlying profit growth. So what we do internally is that instead of looking at market cap, we look at the profit buckets. So if we look at India, out of 5,000 listed companies, there are roughly about 600 companies, only 600 companies, which makes profit in about 90 to 100 crores plus. That's it. There are only 600 companies, and that becomes basically our universe. Now, of course, from the definition perspective, only top 100 is called large cap. It means 82% is actually mid and small cap within that 600 companies. So if you look at our AAA budding beast, which is a mid and small cap PMS offering, often our clients say that probably is only mid and small cap PMS, which does not invest into any small company by profit size, because we invest actually only into leaders, right? So looking at the company from the profit size perspective gives you a lot of different insights rather than just looking at the market cap, number one. And number two, just because company large by market cap, that doesn't necessarily mean that it cannot grow. There are a number of examples, be it a Titan or be it a Trent or many capital goods companies, they're extraordinary returns despite they were large in terms of the market cap. So I think we need to look at profit size and underlying ROCE, and of course underlying earnings growth. These three things are critical for stock to deliver returns, irrespective what cap it is valued.
That's the take coming in on the stocks, the sectors that to watch out for. A lot of stocks are, in fact, that are buzzing in trade today. One of the stock is CE Infosystems of MapMy India. Earlier today, we actually caught up with Rohan Verma, who's the CEO and the executive director at the company, who shared the outlook for the revenue, the margins going forward. And remember that initiation note from Goldman Sachs has definitely perked up the stock. Listen in.
By FY27, FY28, we're looking to cross a milestone of about 1,000 crores in revenue. And if you see the past 3-4 years track record, we've been growing at a CAGR of about 38%. There's a lot of growth opportunities ahead for MapMy India if you look at the areas that we play in, which is maps, IoT, and drones. If you look at the track record, and we've always maintained that, at least in the past, that we're looking at a 40% plus EBITDA margin at the annual level and 30% plus PAT margin. The focus really is between growth and margins.
If you like this video, then like, share and subscribe to ET Now.